Welcome back, everyone. Today we're diving deep into one of the most talked about names in the AI and defense sector, Bigbear.ai, ticker symbol BBAI. The company just reported its second quarter 2025 results, and since then, things have been anything but smooth. The stock has been hammered, investors are nervous, and the outlook is raising more questions than answers. So let's break this all down: what's really happening with Bigbear.ai, why the stock has been so volatile, and what investors should keep in mind moving forward. First off, the numbers. Since the earnings release, Bigbear.ai shares have dropped over 21%. That's a steep decline, especially when you compare it to the broader computer and tech sector, which hasn't fallen nearly as much. On August 20th, shares were trading around $5.61, which is a slight recovery from the immediate post-earnings crash, but still well below where it was earlier in the month. Now, if you've been tracking this stock, you know Bigbear.ai is no stranger to big moves. Over the last month, it's down nearly 24%, but over the past year, it's up more than 240%. That's the definition of volatility. For some investors, that's opportunity. For others, it's a headache. The truth is, it highlights the tug-of-war between Bigbear's ambitious growth story and its very real financial challenges. So what actually went wrong in Q2? Revenue came in at $32.5 million, down 18% from the same quarter last year. The main culprit? Delays and disruptions in U.S. Army programs, which play a massive role in Bigbear's revenue stream. When your business relies so heavily on a few big contracts, any hiccup can have outsized effects. That's exactly what we saw here. Profitability metrics weren't encouraging either. Gross margin slipped from 27.8% to 25%, meaning they're making less profit on every dollar of sales. Meanwhile, their adjusted EBITDA loss more than doubled to $8.5 million. And then came the headline shocker, a net loss of $228 million. Most of that was due to non-cash accounting adjustments like derivative remeasurements and a $71 million goodwill impairment. Still, that's a big red flag for investors. Guidance didn't provide much comfort either. Management cut its revenue outlook for 2025 to a range of $125 to $140 million, and even more worrying, they pulled their adjusted EBITDA guidance completely. That suggests the company doesn't have a clear picture of profitability in the near term. Now, management is trying to frame this quarter not as a setback, but as a pivot. Their message is, we're going on the offensive. They're pointing to a bigger sales pipeline, international partnerships, and new strategic initiatives. And to be fair, there are opportunities here. One of the biggest catalysts is the One Big Beautiful Bill OB3. This legislation directs billions of dollars toward national security priorities like border technology, biometric systems, AI autonomy, and shipbuilding. And here's where it gets interesting. These areas line up almost perfectly with Bigbear's product portfolio. They've got VeriScan, a biometric solution already used in airports and seaports. They've got Conductor OS, an AI autonomy platform that recently showed its strength in a major defense exercise. And they've got Shipyard.AI, which fits directly into naval modernization efforts. If Bigbear can capture even a fraction of this funding, it could change the company's trajectory. But here's the reality check. Bigbear's dependence on large Army contracts is a double-edged sword. When things go well, revenue soars. But when programs shift or funding gets delayed, the company takes a direct hit, as we saw this quarter. Management knows this is a problem. They've admitted the business is too concentrated and are working on diversification. They've signed partnerships in the UAE and Panama, expanding into areas like cargo security and port technology. These are promising moves, but it's still early, and execution will take time. Meanwhile, the company is also trying to step into the mainstream. A recent multi-year deal with the NFL's Washington Commanders gives them naming rights to the team's training facility, now called the Bigbear.ai Performance Center. This might seem like just a marketing play, but it's actually quite strategic. Historically, Bigbear has only been known in government and enterprise circles. Getting exposure in professional sports, especially the NFL with its massive national audience, gives them visibility they've never had before. On the balance sheet side, things look better. Thanks to a $293 million equity raise, Bigbear ended the quarter with nearly $400 million in cash and a net cash position of about $250 million. That's a strong cushion, and management says they're ready to use it aggressively to acquire smaller companies, expand marketing, and fuel growth initiatives. In other words, they have the resources to play offense, even while facing current headwinds. But here's where investors need to be cautious. Analysts have been turning increasingly negative. Just a month ago, estimates for 2025 called for a loss of around 41 cents per share. Today, that number has widened dramatically to a projected loss of $1.10 per share. That tells you the street is expecting things to get worse before they get better. And competition? It's fierce. Palantir remains the big dog in this space, with deep government connections and entrenched defense contracts. C3.ai is also making a push, with a broad portfolio, covering predictive maintenance, logistics, and defense readiness. Both companies have scale and reputation on their side. For Big Bear, the only way to stand out is through focused innovation leaning on unique solutions like VeriScan and Conductor OS, and carefully deploying that cash pile to build an edge. From a valuation standpoint, Big Bear trades at a forward price-to-sales ratio of about 10, compared to the industry average of 17. On paper, that looks cheap. But when you factor in the widening losses and lack of clear profitability, the discount is justified. Zacks currently ranks the stock a narrow 4 sell, reflecting both negative earnings momentum and underperformance versus peers. In plain English, analysts don't see a near-term rebound. So what's the takeaway here? Bigbear.ai is caught between potential and reality. On one side, they're aligned with powerful structural tailwinds, national security spending, AI adoption, and global expansion. On the other side, they face execution risks, widening losses, and heavy reliance on a few contracts. If you're bullish, you're betting that the company's cash, products, and partnerships will eventually outweigh the near-term pain. If you're cautious, you're probably waiting for clearer signs of execution before jumping in. Either way, one thing is certain: volatility isn't going away anytime soon. This is a stock that can swing 20% in either direction within weeks, and only those prepared for that kind of ride should even consider stepping in. And as we wrap up, remember this: sometimes the details that seem small, like contract timing, product validation, or even a line in a government bill, end up making the biggest difference. So keep your eye on every update. This is not financial advice.